The Psychology of Money by Morgan Housel is a book that teaches you how to manage money in a way that makes it easier to attract wealth. If one understands the psychology behind money, they can attract substantial wealth. Money is not scarce. It is available to those who know the rules of the game. Read this book now to learn the psychology of money and attract abundance. Many times we wonder how some people, despite having a lot of money, live a mediocre life, while others, with limited income, become millionaires in the long run. Whether you believe it or not, the financial decisions you are making today will significantly impact your financial status in the coming years. So why not understand the psychology of money now and reap its benefits as early as possible? Today we will talk about a book called The Psychology of Money by Morgan Housel. This book examines personal finance through the lens of human behavior. Unlike many personal finance books that focus on how the stock market works, how to select stocks, or build a portfolio, Housel focuses on the relationship between people and money. To understand why people burden themselves with debt, you don't need to know interest rates. Instead, you need to understand greed, insecurity, and optimism. Good financial behavior has less to do with intelligence and more to do with how you behave. Engaging in the right practices increases your chances of success. Similarly, no amount of intelligence, understanding, or insider knowledge can save you from the consequences of poor behavior. Every chapter in the book reflects on human behavior and attitudes toward money. Some behaviors guarantee good results while others lead to failure. Let's dive into 12 key lessons from this book. 1. Everyone's perspective is unique. Everyone has a different perception of how the world works. Your worldview is shaped by various situations, values, and external influences. While your personal experiences with money might form only 0.1% of the world's events, they make up 80% of how you perceive the world. Nothing can completely eliminate your fears and uncertainties, no matter how much you learn or how open-minded you become. We all think we know how the world works, but our experiences are only a fraction of reality. For example, in the United States, low-income individuals spend $400 annually on lottery tickets. Higher-income individuals might find this shocking, but unless you put yourself in their shoes, it's hard to understand why they do this. 2. Luck and risk play crucial roles. Your efforts determine your results, but luck and risk also play significant roles. For instance, Bill Gates attended one of the few high schools in 1968 that had a computer. If it weren't for teacher Bill Dougal, who bought a $3,000 computer, Gates might not have achieved the same success. Gates acknowledges that without Lakeside School, Microsoft wouldn't exist. Similarly, Kent Evans, a brilliant student and friend of Gates, was poised for success but tragically passed away before graduating. This highlights how uncontrollable factors like luck and risk can influence outcomes. 3. Knowing when you have enough. This is illustrated in a story about authors Kurt Vonnegut and Joseph Heller. At a billionaire's party, Vonnegut pointed out that the host earned more money in a day than Heller did from his best-selling novel. Heller replied, "Yes, but I have something he will never have: enough." Knowing what is enough helps avoid unnecessary risks. Comparing yourself to others is a mistake. While capitalism is excellent for generating wealth, social comparisons create an endless cycle of dissatisfaction. Enough means understanding what to avoid so you don't end up regretting it later. Some things, like reputation, freedom, friendships, family, love, and happiness, aren't worth risking no matter the potential gain. 4. The power of compounding. Warren Buffett's wealth isn't just due to his investing skills, but also because he has been a consistent investor for over 75 years. His financial success stems from the foundation he built early on and maintained over time. Investing isn't just about achieving the highest returns. It's about earning good returns consistently and letting compounding work its magic over time. 5. Earning money versus keeping money. Earning money and retaining it are two entirely different skills requiring distinct mindsets and strategies. To earn money, you need to take risks, be optimistic, and put yourself out there. To keep money, you need humility and an awareness that what you've built can be taken away just as quickly. This balance between earning and keeping wealth is one of the core principles of financial success. The book offers a fresh perspective on managing money, emphasizing the importance of behavior over knowledge. It's not just about how much you know, but how you act. The lessons in the psychology of money are timeless and applicable to everyone, regardless of their financial background. Lesson 5. Becoming rich versus staying rich. Earning money and keeping it are entirely different things, requiring distinct mindsets and strategies. To earn money, you need to take risks, stay positive, and put in immense effort. On the other hand, keeping money requires humility and a healthy fear that what you've earned could vanish quickly. Michael Moritz, a venture capitalist, says, "We understand that tomorrow will not be like yesterday. We cannot rest on our laurels. We cannot afford to be complacent, assuming past success will guarantee future achievements. To adopt a survival mindset, you need 3 things. Aim for financial resilience. Be strong enough to endure market fluctuations, and stay in the game long enough for compounding to work its magic. Accept that no plan will go perfectly as planned. Every plan has room for error. The more you rely on a specific factor for success, the weaker your plan becomes. Stay optimistic about the future, but remain vigilant about the challenges that lie ahead." Lesson 6. Tails, you win. This is the story of Heinz Berggruen, an art collector who amassed an impressive collection of works by Picasso, Braque, Klee, and Matisse. People were in awe of his investment skills, but the truth was that he bought a large volume of art, of which only a small fraction turned out to be valuable. Berggruen often made mistakes, but he succeeded in the end because of the rare few wins that outweighed the failures. Anything significant, profitable, famous, or influential is often the result of a tail event, 1 in 1,000 or 1,000,000 occurrences. In venture capital, for example, a fund might make 100 investments, expecting 80% to fail, a few to do moderately well, and 1 to 2 to yield exceptional returns. In the stock market, most companies fail, a few perform decently, and only a handful produce extraordinary results. Understanding that tails drive everything in business, investment, and finance teaches you that many things will go wrong, break, or fail, and that's entirely normal. Lesson 7. Wealth is what you don't see. Wealth is the financial asset that hasn't yet been converted into something tangible. Housel points out that when people say they want to become millionaires, they often mean they want to spend $1 million. Spending $1 million is the exact opposite of being a millionaire. The difference between being rich and being wealthy is that the rich flaunt their money through big houses and fancy cars. Wealth, on the other hand, is hidden. It's the saved income, not the spent one. Wealth represents options, flexibility, and growth. It means being capable of purchasing what you need without financial stress. Lesson 8. Save money. Once you reach a certain income level, there are 3 types of people: those who save, those who don't think they can save, those who don't feel the need to save. Your savings rate matters more than your income or investment returns. Don't worry about what others think. Control over your time and having options are the most valuable currencies in the world. Lesson 9. Reasonable, rational, and room for error. When making financial decisions, don't strive to be entirely cold and rational. Aim to be reasonable instead. Reasonableness is more realistic and allows you to stay consistent over time, which matters most. The odds of making money increase with time. Political scientist Scott Sagan says, "Things that have never happened before happen all the time." Remember, past performance does not guarantee future success. The best plan is one that accounts for things not going as planned. Building room for error, expecting uncertainty, is the only way to navigate a world driven by unpredictability. For instance, relying on a single income source without savings can lead to disaster. A rainy day fund is a good idea. Save money for unforeseen events. Lesson 10. You will change. We are poor predictors of our future selves. What we want and need today may not align with our future desires and needs. Long-term thinking and decision-making are challenging, but recognizing that change is inevitable can help. Sunk costs, continuing a bad decision because of past investments, enslave our future to our past. For example, continuing a failing business just because you've already invested a lot in it is counterproductive. Letting go of sunk costs helps avoid future losses. Lesson 11. The seduction of pessimism. Negativity is not only more common than positivity, but also seems smarter. It grabs more attention. Tell someone that everything will be fine, and they may dismiss you. Warn them of danger, and they'll listen intently. Psychologist Daniel Kahneman says, "There is an evolutionary history behind the asymmetry between positive and negative expectations and experiences. Obstacles often give rise to innovation. For example, when oil prices rose in 2000, new methods of extraction became economically viable. Similarly, progress may be slow, but humanity continuously innovates to overcome challenges." Lesson 12. Confession. In this lesson, Housel shares his financial philosophy and habits. His driving financial goal is freedom. He enjoys low-cost activities like exercising, reading, and learning. He doesn't own a mortgage-backed home, believing it offers peace of mind even if it's not the best financial decision. He keeps 20% of his assets in cash to avoid selling stocks during emergencies. He invests solely in low-cost index funds, avoiding individual stocks. Housel emphasizes that while outperforming the average market is possible, it's far harder than most realize. For most investors, long-term investing in low-cost index funds yields the best results. Book review: The Psychology of Money. Morgan Housel's The Psychology of Money offers profound insights into how people think about money and the psychological biases that influence financial decisions. Successful investing isn't just about understanding financial concepts, but mastering emotions and psychological tendencies. Housel's engaging writing style uses anecdotes and real-life examples to make his points clear. He highlights the importance of avoiding impulsive decisions, adopting a long-term perspective, and understanding the role of luck in financial success. This book is a valuable resource for anyone interested in the psychology of investing and making better financial decisions.